This video is for general informational purposes only and does not constitute legal or tax advice. Tax rules can change, and individual situations vary. Most self-employed people don't get into trouble because they earn too little. They get into trouble because they forget one simple thing. Not all the money in their bank account is actually theirs to spend. So how do you set aside money for taxes properly? In this video, we'll break down a simple system for separating tax money before you spend it. You'll learn why tax bills feel so painful, how to avoid last-minute panic, and the simple habit that makes tax season much easier. The biggest problem with self-employed tax is timing. When you're employed, tax is usually deducted before you receive your pay. But when you're self-employed, the money often lands in your account first, and the tax bill arrives later. That delay is what catches people out. The common mistake is treating every payment as available spending money. A client pays you £1,000, and it feels like you've made £1,000. But part of that money may need to go toward tax. If you spend it all, the tax bill becomes stressful later. The solution is simple. Before you spend anything, separate a portion of each payment into a tax savings account. Think of it as paying your future tax bill first. This one habit can prevent panic months later. A separate account makes tax money harder to accidentally spend. If tax money sits in your main account, it gets mixed with everything else. Bills, shopping, business costs, personal spending. But when it's separated, it becomes much easier to manage. Here's a simple example. Let's say a client pays you £1,000. Instead of treating the full amount as spending money, you immediately move a portion into your tax account. The rest can then be used for business costs, personal drawings, or savings. The key is making the separation automatic. But here's where people make another mistake. They guess. They put aside a random amount and hope it's enough. That might work sometimes, but it can also leave you short. A better approach is to base your savings on your expected profit, tax band, and whether national insurance may apply. Remember, tax is usually based on profit, not total income. Profit means your income minus allowable business expenses. So if you earn money but also have valid business costs, those costs may reduce the amount you're taxed on. Here's why this matters. You might have a good month and earn more than usual, but if you spend all of it straight away, you may not have enough left when tax is due. This is called a cash flow problem, and it's one of the biggest reasons people struggle with tax bills. A smart approach is to build a buffer. That means setting aside slightly more than you think you'll need. This gives you breathing room if your tax bill is higher than expected, or if your income changes during the year. The next step is to use reminders. Tax deadlines often feel far away, until suddenly they're close. Set calendar reminders months in advance, not just for the payment date, but for organizing records and preparing your return. Finally, review your numbers regularly. If your income changes, your tax savings may need to change too. A quick monthly review can help you stay on track and avoid nasty surprises later. The key takeaway is simple. Don't wait until tax season to think about tax. Every time money comes in, separate your tax money first. That way, when the tax bill arrives, it's not a crisis, it's already planned for. But setting money aside for tax is only one part of staying in control. The next big question is this: should you run your business as a sole trader, or set up a limited company? In the next video, we'll compare both options simply, including tax, paperwork, legal responsibility, and when each structure might make sense. Subscribe to Simply Explained Studio for clear, simple explanations of tax, business and money.